Jeff Camarda. It is Thursday, June 25th, with not a whole lot to report. The markets, as you noticed, and we reported yesterday, kind of got pounded on the news of mounting COVID, continuing problems, getting worse across the country, across the world. Particularly here in Florida and some other states, but that's, you're aware of all of that. So the markets got pounded yesterday. We're flat for most of the day, and then rallied a bit toward the end of the day, not making back nearly all of the losses for yesterday, but that's the nature of the market. So we'll wait and see what happens. Again, we got two countervailing forces. We have the horror and the dread and the huge economic calamity of this expanding toxic cloud of COVID, and repeated iterations and waves, which probably will reverberate for years, absent a remarkably effective and expeditious vaccine. So we have, the horror of the great bear of COVID, and then we have the Fed and central governments, around the world, central banks around the world, rather, dumping money in, creating money out of thin air to try to stave off the worst of the economic disaster. So we'll see which will win. Certainly, the Fed is doing a great job with that. That I feel that there are other shoes to drop out of the COVID trade, and we'll see the market trend sharply lower later on. But I could be wrong. So we're happy to be positioned where we are now, relatively conservatively, about half in cash. And depending on the structure or the nature of the portfolios, the others are deployed in asset classes that we expect have and will continue to do well in the new COVID environment: technology, biotech, consumer durables, that sort of thing, as I've reported in the past. One other thing that's worth mentioning now, I think, is we are at a time of year that historically has underperformed dramatically. I'm sure you've all heard the old saw, sell in May and go away. And that really just expresses the fact that the markets tend to do well early in the year and to not pick up again till like November and December toward the end of the year. So we do have the headwind of seasonality against us, which would argue for much lower stock prices through the middle part of the year. But who knows? I mean, a lot of that, that seasonality just may be driven by people on vacation, not paying attention to investments, traders, at the Hamptons and out of Manhattan, and ain't few people going anywhere this year. So we'll just have to wait and see. So that's really it for the nonce. We'll have another update tomorrow, June 26th. Until then, I got to see if I can find a way. This is really an experiment with these glasses. I'm just trying to see if there are some that are not annoyingly glaring into the camera, because sometimes I need to read something. But we'll keep experimenting, and maybe we'll find something that works. Anyway, adios for tonight. See you tomorrow. Bye-bye.